The United States Treasury market is the largest bond market on Earth.
Carver, sure. RIN, it finances the government of the United States.
And its interest rates influence the global financial system.
The Federal Reserve interacts constantly with this market.
When Treasury yields move, financial markets around the world respond.
U.S. Treasuries are debt issued by the United States government.
They allow the government to borrow money from investors.
These securities come in different maturities.
Treasury bills are short-term instruments. This is rooming.
Notes and bonds represent longer-term government borrowing.
These securities are sold through regular Treasury auctions.
Major financial institutions participate as primary dealers.
This is the Treasury auction, a high-stakes game.
The auction determines the yield investors receive.
This process funds the operations of the U.S. government.
After issuance, Treasuries begin trading in the secondary market.
Here, investors buy and sell previously issued securities.
Daily trading volumes can reach enormous levels.
The dramatic movements of the Treasury yield curve reflect immediate market responses.
Treasury yields serve as benchmarks for financial markets.
The Federal Reserve plays a critical role in this market.
It buys and sells treasuries to influence liquidity. This dynamically shifting yield curve is a direct reflection of the Fed's operations, illustrating the immediate impact on interest rates.
During crises, the Fed may purchase large quantities of treasuries.
Such actions can stabilize the financial system.
U.S. Treasuries are widely considered the safest financial asset.
Investors trust the credit of the United States government.
With indices flashing red across the board, the smart money is moving fast. This dramatic spike in Treasury demand.
This movement is known as a flight to safety. As we can see here, the surge in demand is causing the Treasury yields to plummet, confirming the inverse relationship in this volatile market. U.S. Treasuries also function as collateral.
In the repo market, they secure short-term funding.
This mechanism helps maintain liquidity across markets.
It allows institutions to finance large positions.
The scale of the repo market, the true foundation of our financial infrastructure, has grown exponentially, now exceeding $20 trillion.
In September 2019, the U.S. repo market experienced sudden stress. Short-term borrowing costs surged unexpectedly.
The Federal Reserve intervened to restore liquidity.
Large repo operations helped calm the market.
But the event exposed structural vulnerabilities.
In March 2020, the Treasury market faced severe volatility.
Investors rushed to raise cash across global markets.
Even U.S. Treasuries were heavily sold. The Federal Reserve stepped in with massive purchases.
These purchases restored stability to the Treasury market.
The Treasury market anchors the global financial system.
Central banks around the world hold treasuries as reserves.
They support the global role of the U.S. dollar.
The data clearly demonstrates how global investment decisions often follow the influence of these benchmark yields, impacting capital flows.
For this reason, markets everywhere watch this benchmark.
The total amount of U.S. government debt has expanded dramatically.
As spending rises, the Treasury issues more securities.
Financial intermediaries help absorb this growing supply.
During stress, liquidity in the market can become strained.
As the market grows, its structure continues to evolve. Regulatory mainstays merging. Regulators are studying reforms to strengthen the Treasury market.
Central clearing is one proposal to improve market resilience.
Greater transparency is also being introduced.
These efforts aim to reduce systemic risk. The Treasury market continues to adapt to new challenges. The U.S. Treasury market is the cornerstone of the nation's financial stability, financing the enduring purpose of the United States government.
It sets the benchmark for interest rates worldwide.
Banks, funds, and governments all rely on it.
Its yields influence trillions of dollars in assets.
Its liquidity supports the modern financial system. Treasuries also power the repo market. During crises, its stability becomes critical.
Few markets carry this level of importance.
It forms the backbone of the dollar-based financial system.
Understanding it reveals how global finance truly works.
Treasury yields reflect expectations about the economy.
Markets respond instantly to these signals. Investors across the world allocate capital around them.
This market connects governments, banks, and investors. The United States Treasury market is the foundation of modern finance.